What if retirement income did not require stock picking? What if a carefully selected group of dividend ETFs could potentially create a growing passive income stream for decades while simultaneously providing capital appreciation? Most investors approach retirement income backwards. They chase the highest yields available, only to discover that many high-yield investments suffer from weak fundamentals, declining earnings, or unsustainable distributions. The reality is that wealth is rarely built through yield alone. It is built through compounding. The combination of dividend growth, earnings growth, and reinvestment can transform a modest portfolio into a significant income-producing asset over long periods. In today's video, I will show the exact dividend ETF portfolio I would build today if my objective were simple: generate rising retirement income while maintaining exposure to high-quality American businesses with durable economic moats. By the end, you'll see how 4 carefully selected ETFs can create exposure to hundreds of companies, many of which belong to the elite group of Dividend Aristocrats and Dividend Kings. The first ETF is SCHD, the Schwab US Dividend Equity ETF. For many income investors, SCHD has become the gold standard. The fund screens for companies with at least 10 consecutive years of dividend payments and evaluates factors such as free cash flow, return on equity, dividend yield, and dividend growth. Current yield is approximately 3.2 to 3.4%. Its 5-year dividend growth rate has been roughly 8.7% annually. This combination is rare. Many income funds offer yield. Few offer meaningful dividend growth. SCHD's portfolio includes companies with powerful moats, strong balance sheets, and shareholder-friendly capital allocation policies. If I were building a retirement portfolio today, SCHD would serve as the income engine. The second ETF is VIG, Vanguard Dividend Appreciation ETF. Unlike SCHD, VIG focuses less on current yield and more on consistent dividend growth. Companies must generally demonstrate long histories of increasing dividends before entering the portfolio. The ETF currently yields approximately 1.5 to 1.7%, while maintaining a 5-year dividend growth rate around 8 to 10%. Next comes DGRO. DGRO requires companies to demonstrate dividend growth while also maintaining sustainable payout characteristics. The ETF yields roughly 2% and has produced dividend growth near 7% annually over the past 5 years. Together, VIG and DGRO increase exposure to companies prioritizing long-term earnings expansion and dividend growth. These funds are not designed to maximize income today. They are designed to maximize future income. That distinction matters tremendously for retirement planning. The fourth ETF is NOBL. NOBL tracks companies within the S&P 500 that have increased dividends for at least 25 consecutive years. This is one of the purest Dividend Aristocrat strategies available. These businesses have survived recessions, inflation cycles, financial crises, and changing economic environments. My allocation would look like this: 40% SCHD, 30% VIG, 20% DGRO, 10% NOBL. This structure balances current income, dividend growth, quality, and diversification. More importantly, it avoids overconcentration in any single sector or strategy. Now consider a hypothetical scenario. Imagine a $1 million portfolio invested according to these allocations. The blended portfolio yield would likely fall near the 3% range depending on market conditions. That translates into approximately $30,000 in annual dividend income initially. But the real story is growth. If the portfolio achieves dividend growth between 7 and 8% annually, income could potentially double roughly every 9 to 10 years. After 2 decades, the original income stream may look dramatically different. This is where yield on cost becomes powerful. Your portfolio may still yield 3% to new investors, but your personal yield on original capital could become substantially higher due to years of dividend growth and compounding. That is how many long-term DGI investors eventually build meaningful passive income streams. Every strategy has risks. Dividend investing is no exception. The first risk is valuation. Quality dividend companies often trade at premium multiples because investors recognize their stability. Overpaying can reduce future returns. The second risk is concentration. Certain dividend ETFs can become heavily weighted towards specific sectors. The third risk is dividend traps. A high yield is not always a sign of strength. Sometimes it is a warning signal. Declining earnings, deteriorating free cash flow, or unsustainable payout policies can eventually lead to dividend cuts. That is precisely why dividend growth matters more than headline yield. Growth usually signals business strength. Yield alone does not. Dividend investing, while seemingly attractive due to regular income streams, comes with its own set of risks that investors often overlook. Understanding these risks is crucial for making informed investment decisions. Let's explore 3 primary risks associated with dividend stocks. First, there's valuation risk. Many quality dividend companies are overvalued, meaning their stock prices are inflated relative to their intrinsic worth. This can lead to lower returns, even if the dividend yield appears attractive. Paying a premium for a stock can negate the benefits of a steady dividend. Second, we have concentration risk, particularly prevalent in dividend-focused ETFs. These ETFs often heavily weight certain sectors such as financials, utilities, or consumer staples to achieve their target yield. While this provides steady income, it exposes investors to significant sector-specific downturns. A single sector shock can disproportionately impact the entire portfolio. Lastly, be wary of dividend traps. These are companies offering unusually high dividend yields, which can be a red flag. A high yield often signals underlying business weakness or an unsustainable payout policy. When a company's earnings and free cash flow decline, its ability to maintain high dividends becomes questionable. The dividend might be cut, leading to a sharp drop in stock price and a significant loss for investors. Ultimately, for sustainable long-term growth, focus on dividend growth rather than just high yield. A growing dividend indicates a strong, healthy business that can consistently increase its payouts over time. The most important question is not which ETF has the highest yield. The real question is, which portfolio can continue increasing income 10, 20, or even 30 years from now? That is the philosophy behind dividend growth investing. Focus on quality. Focus on compounding. Focus on sustainable dividend growth. Now I'd like to hear your perspective. If you were building a retirement portfolio today using only dividend ETFs, would your allocation look different? Leave your answer in the comments below. If you found this analysis valuable, consider subscribing for more institutional-grade dividend growth investing research. This content is provided for educational and informational purposes only and should not be considered investment advice. Investors should conduct their own due diligence and consult qualified financial professionals before making investment decisions.